Welcome back to our intermediate financial accounting class. This is our last section on pensions. We've already talked about so many details, why pensions are important, what they are, the different categories, how to do the simple journal entries for defined contribution, the more extensive journal entries for defined benefit, and all the different pieces that go in to that extensive calculation. In our last couple of segments, we walked through a comprehensive example that has gone step by step through the whole process from A to Z on a complete defined benefit problem. And then as we wrapped up, I challenged you to take a few minutes and do the year 5 and year 6 entries just to check and see how you were able to do with these calculations. So that's what we're going to pick up. I'm not going to do a lot of calculations. We're just going to briefly walk through the worksheets, journal entries, and other calculations that are part of year 5 and year 6. So just as a reminder, here are numbers for years 5 and 6. We pick up right where we left off. So the ending balances for year 4 are going to become the beginning balances, and there they are. We've got the 131, that's the remaining prior service cost, the 102, that's our actuarial gains and losses, and then you can see the numbers there for our funded status of 409. And then you can see that I've put in the rest of the calculations. So let's just briefly walk through it. You've got 130 given to us as the service cost. I take the projected benefit obligation times the discount rate provided, which was 8%, and then the plan assets times the 9% that was provided as our estimated return for year 5. And that gives us our 3 normal adjustments. If we drop down, there's the $225,000 contribution and the $125,000 that we actually paid out to our retirees. And then we had the actual return of $140,000. So we actually did really well this year. We estimated only $89,000. We really made $140,000. Finally, we seem to be starting to get this right with our estimates. And then the last thing we needed to account for was the actuarial adjustment. The actuary said that our plan needed to go up by 97. That's a credit to the obligation and then a debit to the gain or loss. And that takes care of step 3. For step 4, we know we have to amortize away prior service costs because we have a balance up here. And if we have a balance up here, we have to amortize it away. So we go back to our table, and there's our year 5 number. Again, we were smart at the beginning. We did our whole table. So I don't have to go through and make a bunch of calculations. They're right there. So I need another $33,000. While we're on this PowerPoint slide, let's just take a look at the corridor. There's 0. And our PBO is still the bigger piece. So we're at 140 at the top, negative 140 at the bottom, and we have a balance of 102. So we're okay. We don't need to do any corridor smoothing this time around. So that adjustment is simply 0. And if we look at our pension worksheet, there's nothing in that row because we don't need to make any kind of an adjustment. So now that we've done all of our calculations, we've put in all of our numbers, let's take a look at the final set of numbers down here. We end up with 186 for our pension expense, 33,000 as our prior service cost being amortized away, which drops us to 98 as our new ending balance. We started with 102 in our actuarial gain and loss account, 46 debit as our journal entry amount, which brings us to 148 as an ending balance. 225 in cash, no ending balance there. We don't worry about an adjustment here, but you can see that we end up with 1.6 million as our projected benefit obligation. It's gone way up, and our plan assets have also gone way up as we've invested a lot and had a good year with our returns. So we're up to 1203, drops our net amount down to 383. And now that I have those numbers, I can do my journal entry. We start again by taking that 186 and splitting it into its 2 pieces. This time we've got 130 that will be our compensation expense. So 186 minus 130 gives us 56 that'll go into our net pension cost. And then from there we can just go straight across our row. So let's go ahead and bring this up. Compensation expense 130, net pension cost 56. That's exactly what we wanted to get that total pension cost of 186. We've got our accumulated OCI for actuarial gain or loss. In this case, it was a loss of 46. We amortized away some of this prior service cost for 33,000, and then we had our cash for 225. If we net those out, the 130 plus the 56 plus the 46 minus the 225 and the 33, we end up needing a debit of 26 to balance,
which wraps up our journal entry, but we don't stop with our journal entry. We always do our T account just to make sure that we've got the right values. So we started with 409 credit as our beginning balance. And now we've debited by 26, so we end up with 383 as our ending balance in our net pension obligation. We check that with our ending balance from our worksheet, and sure enough, credit of 383, that's exactly what we wanted.
Now, if you're not comfortable with those numbers, please stop here, take a look, make sure you get them numbers before you move on. It doesn't make any sense to look at year 6 unless you're sure you've got your year 5 numbers worked out, because we're going to start year 6 with the numbers from year 5. The beginning balances for the new year are the ending balances for the old year. So you can see that we've already got those in here. Prior service cost is all the way down to 98 as we amortize it away as people keep working for us. Actuarial gains and losses has popped up to 148. Not as high as it's been in the past, but still pretty high. Funded status, there's that 383 with our PBO and our plan assets. So that's step 1, bringing those balances in from last year. Service cost was 140, increases our expense, increases our obligation. Interest cost this time around was 11% times the 1,613. That gives us the 177. Our estimated return is 10%, so the 1,230 times the 10% gives us the 123, reduces the expense, debits into our actuarial gains and losses. Jumping down towards the bottom for step 3, contributed 160, paid out 140, had a good return of 128. Notice that, again, we may not be dropping that actuarial gain and loss really fast, but at least our numbers are starting to match up better as the company gets better at getting an expected return that makes sense. And then we had another decrease to our PBO because of an actuarial adjustment, drops that by 13, and we get a credit to actuarial gain and loss of the same 13. As for step 4, before we look at those numbers, let's take a look at our tables. Remember that if we've got a prior service cost, we have to be amortizing away some of that. So we go to our table, which we carefully created all the way through. Our year 6 number already calculated, rounds out to 30,000 in our table. So I need that adjustment for my prior service cost, and we can see it right here. Again, I'm dropping the prior service cost, so since it has a debit balance, I need to credit it. I get a debit to my pension expense. For my smoothing, again, the PBO is bigger, so we stick with that as our top and bottom of our corridor. And our balance is high, but it's still lower than the corridor. Therefore, we don't need to make any kind of adjustments. So we can leave that at 0. With that done, that wraps up step 4. We can jump down to the bottom and wrap up our worksheet. So we end up with 224,000 as pension expense, 30,000 credit as our adjustment to prior service cost, which gives us an ending balance of 68,000 debit. Actuarial gain and loss, we get a credit of 18, which gives us an ending balance of 130. Cash, of course, we get a journal entry amount, but no ending balance. And we don't worry about this journal entry amount because I'm going to do a plug figure later. We end up with a projected benefit obligation of 1,777 and plan assets of 1,378, which gives us a net credit amount of 399,000. So let's take a look at our journal entry. We'll take that 224 and split it into 140 for compensation expense and 84 that will be our net pension cost, and then we can put in the rest of those numbers just as they appear. And that gives us this journal entry. We have our compensation expense and net pension cost. Then we've got cash credit for 160. We've got accumulated OCI prior service cost of 30. This time it's an actuarial gain because it's a credit of 18. And in order to make that balance, 140 plus the 84 minus 160 minus 30 minus 18. This time we need a credit to make it balance, so we put in a credit of 16,000. Now let's go ahead and do our T account just to make sure that everything's ready to go.
We started this period with a credit balance in our net pension obligation of 383. We've credited 16 for a grand total of 399, and we'll compare this value with the value down here at the end of our pension worksheet, and sure enough, a credit of 399. Looks like we did it just right.
Wow, that's a lot of information, isn't it? All of the different pieces that have to come together to really get a picture of our defined benefit obligations. Defined contribution, pensions, those are simple. Debit to pension expense, credit to cash, done. But there's a lot involved with our benefit obligation if we've got a defined benefit pension. The good news is, again, this is job security for us. It's a good thing that we have all of these pieces that we get to keep track of and explain to others and report so that our investors know what's really going on. Now that you're comfortable with pensions, at least I hope you're feeling comfortable with pensions, it's time to move on to some of our other expenses in our income from operations section. We'll see you next time.